by Callum Laing, founder and CEO of MBH Corporation. And today's keynote is devoted to the question how to get textile growth from old economy businesses. Callum, could you briefly introduce yourself?
Yeah, so my name's Callum Laing. I'm originally a New Zealander, grew up in the UK, and I've been living in Asia for 20 years. Right now I'm in Singapore. And for the last 5 years, so I've been an entrepreneur for the last 25 years. But for the last 5 years, I've been helping small companies go public through a particular model, which I'll explain with you today.
Thank you so much. Please go ahead with the presentation. We're happy to share it with our audiences who are mostly serial entrepreneurs and VC investors.
Great stuff. Okay, hopefully everyone can see that.
Yeah, sure. Nice.
Okay, good. So this was the topic. If you do have questions throughout this presentation, do feel free to just ping me on LinkedIn or Twitter, and more than happy to answer any questions. So specifically, I wanted to answer this question because it's normally a bit of an eye-catching number. How do you create a 1 billion market cap listed company in 36 months? But the difference between this particular unicorn and some of the unicorns you might have seen to date is what we're looking to do is have it with real customers, with real profits, and paying real dividends. Now, it might sound too good to be true, but hopefully over the course of the next 30 to 40 minutes, I'll share with you the theory on how this works. I'll share with you the practice and the particular case study that we're working on at the moment, and a little bit about how I perceive the future and perhaps how even you guys can participate. So, quick background on me. I've written 3 books, more than happy to, in fact, the latest book I wrote, Entrepreneurial Investing, later in this presentation, I'll show you how you can get a complimentary copy of that. I sit on the World Business Angel Investment Forum as a High Commissioner to Singapore, mainly because it's just a really cool title. And I've done something like over 1,000, I've published something like over 1,000 interviews with business leaders, entrepreneurs, and investors on a series called Callum Connects here in Asia. Been listed a couple of times. The NASDAQ was a highlight. And some of you may recognize that little penguin down in the corner. That's Kinguin, one of the biggest gaming companies in Europe. And I've done some advice. I sit as an advisor to them. Again, feel free to follow me on any of the social media platforms. So what I want to start with is this idea of can a problem be so big we're all blind to it? And it's one of those things that if you're in the world of small business, you kind of just accept some of what you see. And we were looking at this problem of the fact that 50% of the developed world's economy is tied up in small business. 90% of private sector employment is in small business. Now, this isn't the kind of small business, this isn't startups, this isn't early stage businesses, this isn't the stuff that gets all the media attention, the government grants, the VC funding, all the exciting crypto and cannabis and all of that kind of stuff. This is really boring companies. This is the heart of the economy. These are accountants, these are software development, it's swimming pool maintenance companies, but they make up the heart of the economy, and yet they're completely detached from the financial world. So what I addressed in my latest book, which came out earlier this year, is how we can reconnect the capital markets to that small business economy, and by doing so, inject capital into the small business. And one of the objectives that we stated is to see how you can create a platform that will grow to a 1 billion market cap in 3 years. So what I'm going to cover before I get into that is kind of give it some context to you. So some of the historians here, so it's 4 historic financial trends, which leads to 3 optimal states in order to get to that 1 billion market cap. If you want a copy of that book, go to bit.ly, LA token -EI for entrepreneurial investing. That will take you to a landing page that I set up. and I'll send you a copy of the book. Happy to do that. Hopefully you enjoy it. So I want to start with 4 trends, and the first one that I want to talk about quite briefly is something that you'll, especially if you're in the US, you'll be familiar with real estate investment trusts. So in the 1960s, the government made a slight change to a law, and the reason they did this was that there were some huge amounts of money being made in commercial property in the US in the 50s and 60s, but the only people that had access to the sort of funds needed in order to buy these big properties were the equivalent of institutional investors. And the government said, you know what, we want to be able to let retail investors benefit from real estate the same way that big investors are. So they made a small change in the law. It actually took a couple of years before anyone really figured out what it was all about. And basically what it did was it allowed fractional ownership of big property investments. And real estate investment trusts, or REITs as they're known, have gone on to become a $2 trillion or $2.6 trillion industry worldwide. Really, the genesis of that was by giving liquidity to what was previously a completely illiquid investment. So 20 years after that, we had another big shift, and some of you will be familiar with Michael Milken, who as a student discovered, I guess, a slight discrepancy in the way that what's now junk bonds, as they were called at the time, what's now known as high yield bonds. So what he realized was that people, high yield bonds weren't defaulting nearly as much as people expected them to. And actually, what he did was he packaged them up as junk bonds. And for the first time in corporate America, he created a product which allowed investors to inject capital straight into the companies. And so much of what we take for granted today, the planes that we don't actually fly on at the moment, the fiber in the cable in the underground for internet, satellite, a lot of this big infrastructure projects were paid for, and still are today, paid for by junk bonds or high yield bonds. Entrepreneur magazine described junk bonds as the #1 innovation in corporate America. So really was a huge impetus to getting capital into companies, allowing them access to invest in growth. 20 years later, you had another big shift, and this was the internet growth, the dot-com boom. Now, as a young entrepreneur, I did very well in the dot-com boom. I had a recruitment company selling or recruiting IP engineers for telcos in Europe, and we were very successful. I thought it was down to my innate talent and good looks, and then the bubble burst, and I discovered I was not nearly as talented or good looking as I thought. But this was a huge shift in the way people looked at stocks, and what became incredibly apparent was that investors would pay a massive premium for growth. Now, over the last 20 years, from 2000 to 2020 today, that still exists. Investors will always pay a premium for growth, and we've seen various cycles. Sometimes they want profit, other times they don't want profit. It doesn't matter. It's growth at all costs. But investors really like fast growth. And then now we've got another shift happening, and I think this is a really interesting one. It's something that I've been talking about, and most of my peers have been talking about for more than a decade. We've been talking about social entrepreneurship, CSR, giving back. And yet, while a lot of people were talking and doing quite cool stuff in the small business environment, at a big corporate level, ESG really hadn't started to kind of get into the mainstream thinking. But last year, there was a significant shift. And I think it was a shift that's now pretty much permanent. As somebody that spends my life on the road talking to investors, I noticed last year you couldn't have an investment talk without the conversation of ESG coming up. BlackRock announced that they would only invest in ESG projects from now on, and that's a $7 trillion fund. The American Chamber of Commerce, which up until last year had stated that the sole purpose of a business is to create wealth for shareholders, was forced to change that and admit that there are other stakeholders that businesses exist for: the community, employees, the environment. And so there is this really big shift happening. And the question is, how do you benefit from these shifts? And I guess the question that I've been asking myself is, how do you combine all of those things? Is it possible to get the liquidity from a previously illiquid class, get investment going into businesses, allowing them to actually grow, getting that fast growth that typically only comes with a sort of a tech company, and also making a net positive impact on the world that we live in. So that was kind of I guess, some of the historical context to it. And that led to the front cover of my book, which is these three areas. And it's how do you get that intersection of impact, or ESG, liquidity, and alpha. And let me just drill into those a little bit more. So impact, for myself, when I'm looking at impact, what I'm really looking at is in the small business space. How can you help a company grow and hire people? Because if you can take a company from, say, 10 million to 20 million in revenue, they can't do that without adding another 50 to 100 employees. So that's the kind of impact that I was looking at. Now, at the extremes of that, you could make investments into an angel. You can be an angel investor going into a startup. It makes an impact for sure, but there's no liquidity. It's nearly impossible to get your money back out of that. And to be honest, there's very little alpha. There's a possibility, of course, we all hope we'll back the next Uber, but probability is very low that you're going to get above market returns, and alpha is just Wall Street talk for above market returns. Now, if you want liquidity, and I personally, as an entrepreneur, I love liquidity because I'm always seeing opportunities. I don't want to be tied into a 25-year mortgage when I see these other opportunities to jump on. So I want liquidity. If you just want liquidity, invest on a tracker fund in the market. You get full liquidity, but you don't have a direct impact on the business that you're investing in. You may have a secondary impact, and also you can't get above market returns if you're just investing in the market. You're going to get average. And then you've got alpha, and alpha typically, especially if you were wealthy, the way you got alpha was to invest in private equity or venture capital. But the reality is, both of those classes did a lot better 20 years ago than they are doing today. If you look at private equity, which has typically been that, private equity typically gets 30% above market returns. But 20 years ago, which was private equity's heyday, they were paying half the price that they pay today for companies in terms of multiples, which means they now have to saddle companies with twice as much debt as they were 20 years ago. And so a lot of the companies that you're going to see going bust over the next 3 to 6 months are going to be private equity owned companies that are just carrying too much debt. And even if you are a big private equity fan, most private equity enthusiasts will admit they don't necessarily have a positive impact on most businesses that they come in touch with, and they certainly don't have liquidity. 20 years ago, lockup terms on private equity were around 6 years. Today, it's more likely to be 10 years that your money's locked up in a private equity fund. So getting any one of those three is relatively easy to do. Getting two of those three is quite tricky. Trying to get all three of those, trying to tick the three boxes is really difficult. And that was what I was addressing today and in the book. And the way that we got around this was to create our own vehicle. And we called it Agglomeration. We wrote a book on it 5 years ago called Agglomerate: Idea to IPO in 12 Months. Again, just reach out to me. Happy to send you a copy if you want it. The idea of agglomeration is very simple, is that we create a publicly listed holding company exclusively for the use of these good, well-run, profitable small businesses that are completely neglected in the rest of the world. The accountants, the pool maintenance companies, the carpet cleaning companies. These are companies that oftentimes are 10, 20 years old. They could be spitting out anywhere from 1 to 10 million in profit year on year. They're too small for private equity. And oftentimes the founder doesn't want to exit. They don't want to quit. They just want to take some money off the table. They want to have a bigger platform to play on. So basically what we did is we create this publicly listed company. Small businesses can come in, swap their private stock for public stock, and then carry on running the business exactly the way they always have, but now running it inside the wrapper of a public company. So this is a great platform for small businesses. What it means for small businesses is they now get to go for much bigger contracts because they're part of a global PLC rather than a small private company. They have stock options which they can give to their senior team so they can compete with big companies to attract the best talent. They have a currency of stock which they can use to do their own acquisitions. And of course, the founder can sell some of that stock and actually live the life of a real entrepreneur. So really good solution for small businesses, but also an interesting solution for investors. So this is the case study that I will come on to later. So look, if you look at it from an investor standpoint, investors can't invest in small business currently. So I talked about 50% of the world's economy is in small businesses, but that accounting company or that carpet cleaning company that's 20 years old, spitting off $1 million or $2 million in net profit every year. As an investor, it's very difficult for me to invest in that company. Now that company, one big client contract could double or even triple the profit of that company. Yet for an investor, I'm going to miss out on that. And the reason I'm going to miss out on that is because small businesses are illiquid and they're risky. Anyone that's been an investor for any length of time will probably have invested in a small business and is probably regretting it today because they can't get their money out. So when you look at the market, what investors tend to go with is, do I go for fast growth or do I go for dividend yielding? And that growth versus value argument goes on FinTwit ad nauseum. And it's, for the last 10 years, it tends to go in cycles. For the last 10 years, fast growth has absolutely outperformed. The FANG stocks are just absolutely killing it. Or you typically look at the fast growth stocks don't tend to pay dividends. Older traditional companies tend to pay dividends, but they don't grow as fast. So the interesting thing about an agglomeration is that we have the potential growth speed of a fast growth company because we can bring these companies in all day long into our holding company. We're not trying to merge them. Each company keeps its independence. So if you know anything about mergers and acquisitions, you'll know they often talk about mergers and acquisitions indigestion. And that's when you acquire a company, you try and merge all the systems and the cultures together, and it causes a massive internal conflict, all the talent leaves, and you end up destroying a lot of value. In our model of agglomeration, all the companies stay independent. So you can keep adding companies, you keep adding profit to the holding company. And because you're not using cash for growth, you're using your own stock or even your own bond, that cash that comes with those companies can be redistributed as dividends. So you get a fast growth company paying dividends, and that's a very, very rare combination in the market. So the way that we've put this together is pretty unique. We haven't seen anyone else do this, but the elements of it have all been done before. And this is one of my favorite stories. It's an incredible entrepreneur called Henry Singleton, set up an aerodynamics company, aerotech company in California. And he took that company public in 1961. In 10 years, he acquired 130 companies, predominantly using his stock in order to do that acquisition. So his stock was trading at 24 times earnings. He was buying companies that were 12 times earnings. And over the course of a decade, he grew the profit 600%. And the earnings per share, which is the metric to focus on, went from 3 cents to $8.55. But where this story gets really interesting is that in the following decade, the bull market that had dominated in the 60s turned into a bear market, and his own stock got punished. In fact, his stock went down to an average of just 8 times earnings. And so what Singleton did was say, well, look, we buy value stocks. Last decade, we've been buying companies that were cheaper than ours. Now our own company is cheap, we're going to buy it back. So use their own cash to buy back their stocks. Now, there's lots of controversy today from people that often don't really understand the markets about buybacks, or sometimes they are genuinely used for the wrong reasons. But he bought back his stock. Now, if you had owned shares in Teledyne, you would have got around a 3,000% return on your money. So a dollar invested in Teledyne would have been worth $183. Far outperforming almost every other stock during that period. Now, the concept of buying EBITDA using at a lower multiple than the multiple you're trading at is a little bit complicated, and people tend to get confused by, well, look, if you're just creating new stock all the time, aren't I being diluted? Which is why I said that the metric to focus on is earnings per share. Now, it's called accretive acquisitions. I'm not going to play this video. It's a 3 or 4 minute video on how accretive acquisitions work. If you want to see it, it's on my YouTube channel. It's a good little explainer, but I'm going to leave it for now. And then this is the most uninspiring slide I could possibly put together, but it's kind of an interesting one to just purely look at the maths of it. So what I want you to look at is, this basically assumes that this holding company, this mythical holding company that we're talking about, starts acquiring companies that each company has $1 million of EBIT. Now you see that by acquisition 9, you've got 10 million. So if you look down the bottom, you've got 10 million of profit in that middle column. Now, if the market cap has stayed roughly the same, so around 20 times, which is about the average at the moment, you would end up with a market cap of $200 million, euros, whichever currency you're playing in. So just 10 acquisitions can get you up to 200 million market cap. So if you could do 1 acquisition a month, and I'm going to explain why that's not such a crazy idea. If you do 1 acquisition per month, and in 4 months, you basically 4 or 5 years, you get up to 50 million in profit. Now, market cap you can't control. Market cap is purely the value of your share price, which fluctuates, goes up and goes down. What you can control is your earnings per share and bringing the profit into the company. Now, as we go through this, what I'll try and demonstrate is how in a 36-month period, you can bring in around 50 million of profit. And if you were to get that 20 times earnings multiple, then you get to that billion market cap. So it's actually a relatively simple mathematical formula, which allows this model to work. So that's all good in theory. Let's all go and make a billion market cap in 36 months. Let me just talk you through some of the practice. So we've been working on this model for about 5 years now. And the latest iteration is a company that is called MBH Corporation, Multiple Business Holdings. Not the most creative name, it's got to be said. It's a UK PLC. It's listed on the Frankfurt Stock Exchange, which is one of the most liquid and most flexible main markets in the world. Now, we've kind of been unofficially christened by some of our investors as mini Berkshire Hathaway. And the reason that we got the mini Berkshire Hathaway title or nickname is because if you know anything about Warren Buffett and Berkshire Hathaway, not now, they're too big now, but back in the early days, Berkshire Hathaway was really kind of the home that if you had a well-run, profitable, family-run business, you wanted to be owned by Berkshire Hathaway because you knew that Warren Buffett would leave you alone to get on and run the business the way you wanted to run it. So MBH is the same sort of philosophy. We listed MBH about 18 months ago, and as of today, we have 10 companies in the group, although it kind of changes fairly regularly. We've got 4 industry verticals: education, construction, health, and leisure. And we will add several more industry verticals over the coming months. So I suspect by the end of this year, we should be up closer to 20 companies in the group. If you look at that, just what we've done to date, I know this is there's probably only 5 analysts in the audience that get excited by a slide like this. But you can see that we've brought these companies in from, we actually just released our 2019 numbers, and our 2019 numbers showed that we've grown our revenue by 300%. We've grown our EBIT by about 190%. I think that makes us one of the fastest, if not the fastest, growing small cap listing in Europe. And our pro forma numbers today are around £80 million and about 6.5 million of EBIT. And we just issued our first dividend, which again, for a company listing and then issuing a dividend in its first year, is quite a unique achievement. So you can see it grows very quickly when you're bringing these companies in. And to be honest, we actually started a little bit slowly, but once you get momentum, once companies see companies like them being in the group and achieving organic growth, and this is one of the key things, there's 3 drivers of value to this model. The first is obviously the accretive nature of the acquisitions, buying this EBIT at a lower multiple than the multiple we're trading at. But the second driver of value is the organic growth. So the companies in the group are often able to go for much bigger contracts because they're in part of a big PLC than when they were on their own. And then the third one is any synergies. So if the companies in the group decide to work together to share resources, then you can wash out some synergies. Anyone in business will know that synergies sound fantastic in textbooks. They very rarely work out in real life because humans get in the way. But there is that opportunity for companies to work together. So our 2019 numbers were very good. We had a great start to 2020. COVID hit. Of course, it's had an impact. Fortunately, most of the companies that we work with are in New Zealand, which has just been declared COVID-free as of today, and the UK, which has a lot of government assistance in place. So I think the companies there will come out of this year pretty good. So that's the model, and now I just want to kind of wrap up a little bit by talking about the future, because this is, interestingly enough, when you look at blockchain and some of the promise of blockchain is about bringing liquidity to an illiquid product. So small businesses are incredibly illiquid. Anything that can help bring liquidity to an asset class that's illiquid is a great thing. We genuinely think that there's millions of great small businesses around the world, and every niche imaginable. We very much hope that we can, with this model, help small businesses grow, because it's much easier to grow when you're part of a group like this than it is on your own, especially when you go through a downturn. So we kind of asked ourselves a few questions, and one of the things that I guess was almost sort of a reaction to the typical Silicon Valley obsession with growth is, if you look at that obsession with growth, and venture capital, their business model is dependent on this outsized growth. Now, the problem with outsized growth, and especially when your business model depends on it, is you put pressure on companies to make decisions that they wouldn't normally make because you need that growth. The problem is the number one killer of small businesses is overexpansion. So actually what we're interested in is longevity. Most of the companies, in fact, the average age of the companies in the group today is something like 22 years old. The founders have been with those companies since the beginning. Often they've been in their industry for 30, 40 years. They know how to react to downturns. They know everyone in their industry. They know the people they trust. So actually, we're much more interested in acquiring companies that maybe only grow at 5% a year for the next 20 years, but they're still going to be there in 20 years. And every year they're going to spit off 1 million or 2 million of EBITDA. The interesting thing is that we don't need to put any pressure on the companies in the group to overexpand or to hit quarterly numbers or anything like that. We as a holding company can grow very, very aggressively, but we do it through acquisition. Once a company is in the group, it has no external pressure on it. We don't want it to make short-term decisions. We want it to make decisions about longevity. And that also applies for the holding company itself. One of the things we looked at was, why do cities tend to last for hundreds, if not thousands of years, whereas the average age for a company is about 16 years? So what we were trying to do with the agglomeration model is create, rather than a traditional company with the sort of the top-down idea that the CEO knows best, is to in fact create a bottom-up structure where the entrepreneurs that run their businesses are the ones that understand their markets, they understand their industries, their teams, what's going on in their business. And basically our job as an agglomeration is to create an ecosystem that's so attractive that more and more small businesses will want to join it, because they know that they can thrive better inside that ecosystem than on their own. And if you create that ecosystem, you're actually constantly being refreshed. Now, sure, certain companies will fade away and die. Certain industries will fade away and die. But if you can keep creating that liquidity and that environment, that stimulation, you'll continue to get good companies in. And so you can start to think of it with that real longevity of, could you create a multi-generational holding company rather than this sort of obsession with growth for the sake of growth. So it's an interesting idea. It's not like, honestly, I don't know whether we've cracked that. We do a full day's training for people. It's in person, so we haven't run one recently, but we do them all over the world on this model. And it's always a question that I leave people with is, how would you design a business to still be here in 300 years time? And it's a really interesting thought exercise. But the one thing that you wouldn't do is focus on growth at all costs. So how do you get involved in this? Well, the first thing that I would recommend, if you're interested in this space, is go to bit.ly, LA-token-EI, download that book, have a read. By the way, if you leave a review on Amazon, for every review I receive, good, bad, or ugly, I donate school books to developing countries, kids in developing countries every month for every review that I leave. So if you do get some value from it, do please leave a review. The other way to get involved is as an investor. So if you want to go from being a frustrated investor to an entrepreneurial investor, obviously do your own due diligence. We're a public company. We put out, I like to think we probably put out more information than most small cap public companies. Follow us on LinkedIn, follow us on Twitter. We share stories about the subsidiary companies. We do a lot of interviews. I do a lot of Q&A. It is a little bit tricky. Not every broker in the US will have our stock listed. But if you email them and nag them, eventually they will. Otherwise, contact me directly. We can see what we can do for you. So become a retail investor. If you're interested in bigger sums, do get in touch as well and become a community member. And basically, we kind of have a smaller group of people that we get around 1,000 companies a year apply for this. Not all of them are right, so we have a few other deals that we're constantly working on, and we tend to push those to our investor community first, so you kind of get a lot of access to deals that you wouldn't normally get. Then of course you get the growth and the dividends that come with it. and that exclusive access to deal, which kind of moves you into that entrepreneurial investor model. And just finish up on why we do this. And it's really an idea that's kind of been with us for a while. One of the things that we realized is that all the best entrepreneurs that we knew in our peer group, that once they'd kind of finished their business careers, they all went into philanthropy. And what you realize is that small business owners, entrepreneurs, are basically problem solvers. And we spend often the best years of our lives trying to solve problems in our business. When we've solved those problems in our business for our clients, we then look at solving problems in the industry. And then once we've kind of exited, once we've had our liquidity event, you see almost all entrepreneurs end up doing some kind of philanthropic work. In fact, anything cool that's happening right now in philanthropy is being driven by entrepreneurs. And it's that idea of that problem solving mindset that entrepreneurs have, coupled with investing, that gets you to that entrepreneurial investing mindset. So that's kind of the big why that drives us, is if we can bring those liquidity events to entrepreneurs earlier on in their process, then they can solve some of the bigger problems that we're facing in the world. So hopefully it's a very different from the typical kind of crypto focus, but hopefully it sparked some ideas for you, and I would love to hear from you. I don't think we've got time for, or we don't do questions, but do feel free to connect with me on LinkedIn, Twitter, and fire over any questions. Follow me on YouTube, or sign up on my website, and I'd love to hear from you.
Thank you so much, Callum. So what would be your key advice to our audiences, which are serial entrepreneurs and VC investors?
Yeah, so I think there's a huge overlooked. There's a lot of us when you're in that sort of VC tech space. There's kind of there's a desire to keep creating new stuff, and so what you end up with is a lot of technology that is solving a problem that isn't really a problem, and those we constantly see these businesses that have great tech that doesn't really have a great audience for it, and yet at the same time you've got this incredible ecosystem, 50% of the world's GDP, that's currently neglected by the finance community. And so I think when you start to look at, ours is just one innovation to try and reconnect capital with the people that create the value in the world. So I think, there's lots and lots of opportunities there. Hopefully more people get involved in it, the better.
Thank you so much. And how not only to succeed in the current environment, but to gain some new markets, because tech is actually developing and disrupting industries in many of the spheres, many of diversified portfolios of our investors across the world. And actually we have this disruption everywhere now, as well as we have a global event of this pandemic. So, and currently we have a shift in the paradigms of all the industries and segments. So how to stay afloat and how to succeed at the same time, being robust, being lean in finance, maybe cutting costs, and at the same time being proactive and gaining new markets.
Yeah, I mean, what's been very interesting is I went through the global financial crisis in 2008, 2009. I did it on my own as a small business owner. I ended up having to lay off 38 of 42 staff. It was a brutal, hideous process to go through. What's very apparent watching the companies in our group is they've all been through the global financial crisis. Many of them have been through recessions in their own industries. And so when COVID hit, they had the maturity to know what problems to solve first. And a lot of it was about acting quick. It was about communicating well to their staff, to their clients. Unfortunately, they had that kind of infrastructure to work with each other and share best practice. But what I would say is that if this is your first, big sort of downturn, then try and find some experienced people that have been through this before, because it's brutal to try and figure this stuff out on your own, and laying people off and doing that as an entrepreneur is it's really the worst part of the job. So do try and reach out to people that have had some experience, because I think it does make a massive difference.
And what is the role of community and this type of online platforms, which are now doing all these roadshow speech competitions, masterclasses, keynotes, and most of the communities are now gathering online, and we have more of a global approach to any even local problem or issue? You mentioned that most of the entrepreneurs are actually problem shooters by nature. So how community can help for individual stories, and how to make us more sustainable and less fragile in the current environment?
Yeah, so actually, if you go to my website, callumlaing.com, and stick your email address in, I'll send you, automatically get a copy of my first book, which was called Progressive Partnerships. And it was a book I wrote a few years ago. But it was exactly that. It was about how to build communities. And while it focuses on offline, all of the concepts behind it work for online. And basically, exactly what you guys have done so well is to find a common interest and connect people that share that common interest. And there's value in communities, and you guys have monetized it well. But I think for the people watching, there's value in a community of 20 people. It doesn't need to be tens of thousands of people online. If you can get together 5 or 10 passionate people that are very interested in a particular niche, that creates value for someone else. I mean, I gave a presentation to a group of community leaders a couple of days ago, and they were talking about how much it costs to rent venues for networking events. I said, look, right now, venues are so desperate to get people coming in that you're going to be able to cut incredible deals just because they're going to want to have people coming in and then hopefully staying after your event and drinking and eating. So there's lots and lots of opportunities to monetize communities, either for your business or for contacts or generating revenue. So I wrote a book on it. More than happy to give it away to any of your audience.
Thank you so much for different types of value shared with our community, for you as well. And feel free to share the link also to our audiences. I think we can put it into the program as well. Thank you all. And in almost 1 hour, we'll get online roadshow, investments and pivots during pandemic, work tech, edu tech, and remote tech. And Callum, you're also welcome to join our different formats of events, which are not only roadshows and pitch competitions and keynotes, but also startup leaders clubs, where we have serial entrepreneurs and VC investors communicating in an open conversation, close to fireside chat, on different challenges and opportunities they are facing, and brainstorming sessions, how to find new ways out of the current situation and how to win in the current environment with the new normal we're all facing. Thank you so much, and see you soon.